This Niveshako Se Samvaad, this is a new initiative from Aditya Birla Sun Life Mutual Fund in this current financial year. Idea of this platform to bring value addition to you on the table. Of course, to have both way the dialogues with you. And that's why, this Samvaad chips in. For today's Samvaad, our topic is future of passives and its importance in the portfolio. In last 2 years, we have seen so many themes around the passives. And to discuss this today, we have none other than Mr. Abhishek Singhal. Hi, Abhishek.
Hi.
So let me introduce Abhishek. Abhishek heads the passive business for Aditya Birla Sun Life AMC, and he's responsible for setting up the foundation and the strategic roadmap for the company in this area. As a part of alternative business vertical of Aditya Birla Sun Life AMC Limited, he also drives the business strategy initiative for the alternative vertical of the AMC. In his previous roles as head products, he was instrumental in creating and providing a strong platform and communications for the investors and distribution partners, as well as delivery of the solutions through various centers of Aditya Birla Sun Life AMC Limited across geographies. Abhishek brings with him over 20 years of rich experience in asset management and investment advisory services across sales, business development, new geography development, product and strategy. He has been Aditya Birla Group since June 2001. In addition to his responsibilities at Aditya Birla Sun Life AMC, he also works with other businesses at Aditya Birla Capital, including life and health insurance, project finance, and real estate advisory to develop alternative products and bundles for Aditya Birla Capital investors. In his earlier roles at Aditya Birla Sun Life AMC, he has been instrumental in developing offshore fund business in Dubai and Singapore, as well as institutional business in North India and establishing retail business for the AMC in the key centers in East India. Abhishek completed his bachelor's degree in commerce with honors and holds a master's degree in business administration. So thank you, Abhishek, for having today with us. And quickly, our first question to you is, please tell us how you see the current spectrum of the passives for the entire world.
So Amit, the growth of passives is not hidden from anyone. And as you started out with, over the last 2 years, it's been sort of a Cinderella story for passives business all across, not only for us. We started out a little late, maybe in a focused manner, though it might be interesting to note that Birla is credited with one of the oldest Nifty 50 index funds. We started our Nifty 50 index fund way back in October 2002. And we also launched the first bond index fund in the industry. That was way back in 2004. This actually predates most of the indexes itself in the marketplace. So frankly, there were earlier attempts at passives, but till 2013-14, there was hardly anything with respect to passives in the industry. There was maybe gold ETFs because of the 2010-11 period. And apart from that, everything else was just, a decimal for our industry. But the last 5 years, and thanks to, the government initiatives behind disinvestment through ETFs, EPFO investment coming through, and all provident funds then following suit, and the massive amount of returns that investors have booked in this space, the markets have given such strong returns. Over the last 2 to 3 years, passives has actually come across in equities, in fixed income, in international space, thematics, and now there are new trends playing out. If I were to talk about India versus the rest of the world, India is just a small part of the overall story. India, anyways, is just about 3% of global market. So it's maybe pertinent to see how the global markets have done with respect to passives. And maybe I can just share this small perspective in terms of data points. If you see the transition of global markets, the way, or the global AUMs, the way they have grown over the last maybe about 20 years, and how they have been stacked up, you can see that the biggest block in the first bar is the traditional mutual funds or the traditional active funds. And out of a $32 trillion AUM in 2003, 53% was active funds. This is typically, for us, it would have been somewhere in the range of about 99 or maybe even 100% at that point in time. As we move forward, fast forward to 2020, you can see that the red bar has compressed and the green bar has actually multiplied relative to the red bar. And you can also see that some of the other bars like solution oriented, hybrids, or active specialties, or alternatives, which is basically for us, it will be AIF and PMS in the Indian context. They have also started to become more and more prominent. I think the global expectation is that another 3-4 years down the line, you would see that all of them will sort of become equal and equal. The point that I'm making is that we are heading towards a bipolar world where either you will have very risky sort of strategies, which is essentially alternatives, which is essentially long shorts, hedge funds sort of marketplace. And on the other hand, you will have something like indexes, passives, or quantitative strategies where the human element will actually get much further reduced. This rule-based approach, which is more objective, which has proven to deliver longer-term efficiency to the market, I think will get more and more and more impetus. And if you were to just look at some of the numbers, some of the key data points, or some of the conclusions from this chart, you can clearly see one thing is for sure, that the fastest growing pie globally and now in India also is passives, number one. Second, a fact that more than 50% flows in all developed markets, including US, which is the largest market. US is about 70% of global markets. More than 50% flows are already in passives today. In India, it is still lower, but the growth rate is much higher. And largely the reasons are pretty similar across the globe. As markets are becoming deeper and they are becoming more and more integrated with each other, more developed, alpha is starting to shrink. And which is the reason why investors are becoming more cost conscious. Hence, they move towards passives, or wherever more exotic spaces are available, wherever more, so to say, inaccessible spaces are there, you still have higher expenses and you still have ability for fund managers to generate that alpha. Role of the fund manager is very important there. These are simple and transparent products, and hence, more and more retail investors flocking towards it. But from a more important perspective, HNI investors are starting to use it more like Lego. You build your own buildings, you build your own characters, you build your own stuff. And institutional distribution, which is more like RIAs or advisors, the smarter fellows, they are starting to use passives more for asset allocation, more for portfolio constructions, and maybe we'll talk about it in more detail. But what it is actually helping is to prove something which was done as a part of research way back in 1990s and even earlier in 1960s once, that asset allocation gives you 90% of your total portfolio return. So what are these guys doing? They're saying that, let me not go after security selection. Let me use these ETF blocks. So thematics is one of the trends. And let me use these ETF blocks to create portfolios, create asset classes, churn those actively, and then generate returns. So passives is now a part of journey for every such portfolio or financial planning process.
Next question is, how do you envisage about the future of passives for entire world and of course India as well?
Sure. So as I was mentioning that globally the AUM is much higher, and even in India, this seems to have become sort of a craze. One of the data points that I would probably want to mention is that in India today, passives is still not comparable to the bigger market. We are still about catching up. Yes, the growth rate is much higher. We are growing at about 60-65% per annum, but the base itself is much smaller. When you look at the global context, the pace of growth and the volume is both pretty high. And what's driving that? Driving that is some of the key trends which are now starting to play out. And I think over the next 2 to 3 years, these are the trends which are going to drive the growth of global AUMs. One of the first trends is interest rates. And I think even in India, part of the growth is responsible, is being added to the same interest rates itself. So as you can perhaps see that Fed has been, and you would have been hearing that Fed has been very actively managing interest rates, and they're talking about sequential rate hikes over the next maybe about 18 odd months. Whenever yields have been typically higher, they've been higher, or whenever Fed has increased rates, they've raised rates to counter inflation. During inflationary periods, high yields as well as high yield bonds as well as commodities tend to be very, very lucrative. And whenever interest rates come down, or whenever Fed has cut rates, equities globally have rallied. Let's remember the fact that dollar is still the base currency for the world. So whenever dollar rallies, whenever rates are cut, it typically triggers a global rally. And its biggest beneficiaries are countries like India, some of the other emerging markets. So as you can see on the left hand side, with higher rates, you have higher yields, and on the right hand side, you've seen the periods being dominated by equities. I think with this rate reversal cycle, we are moving towards fixed income. That's a trend that we have started to see in India already. I think in the Western world, you will see it in a much bigger manner. The second trend which has started to build up, this maybe its second or the third coming, is quantitative strategies. Now, a smarter way, or a better moniker basically is smart beta. Smart beta is nothing but quantitative strategies put across in a very simple manner. So you hear about value, you hear about momentum, you hear about quality, low volatility, alpha, all these sorts of different fancy names that we are hearing. These strategies are actually now tested over a much longer period. Earlier, maybe the base was not there, or the markets were shallow. Now markets are pretty deep. As we saw the AUMs, the global AUM of asset management is over $136 trillion. And with that sort of an AUM, today, this smart beta is actually making a very, very serious dent. If you see the share of smart beta today, it's already moved to about 15% of global AUM, while passive ETFs are only about 69%. Not only, but they are already 69%. And a large chunk is getting to be smart beta. The second trend is active ETFs. Now, what do active ETFs mean? Active ETFs are basically simple ETFs, normal ETFs that we deal with. They are the ones which are typically just replicating an index. In an active ETF, you are building some sort of human element, some sort of sense of security selection, asset allocation, some bit of human touch is there. And this is a big trend elsewhere in the world. I believe that over the next few years, you will see both these active ETFs as well as smart beta playing out in a much bigger manner in the rest of the world, as well as in India as well. Given the fact that India is now one of the serious markets, we are actually the 5th largest market in the world now. The other very big trend, which we've already seen play out in the last 2 years, but the second wave is about to happen. This is not because of COVID; it's on its own steam, but it's actually going to be much bigger. Stuff that we've been seeing, dreaming about through sci-fi movies, stuff that you probably saw 20 years ago in the Matrix series, and you're seeing the Matrix Resurrection now. That is what you're going to be seeing in the coming years, maybe. AI, blockchain, 5G, and cryptos. So these are going to be some of the bigger drivers of AUMs in the next few years. One of the countries, or one of the pieces which is going to drive this growth is China. China, I'm not sure how many of us know, is actually a global leader of technology. We believe that Silicon Valley is the home of all innovation, but China today is many leaps and bounds ahead of US. And I believe that in the coming years, we are actually going to be seeing more of China as well. So these are the 5 trends on the tech side. And the last one that I'm going to be talking about is the commodities trend. Whenever inflation is typically high, commodities tends to do well. And this is perhaps the first time in the last maybe about 7 to 10 years that commodity cycle has actually come back. We've already seen about a year and a half of this cycle. And I personally believe that, another maybe about a year and a half is still there. So commodities is actually going to be playing out in a much bigger manner than it has already. And this is likely to drive, more development of new products, etc. Very recently, you saw a new commodity coming to the passive world, silver. And with so much of interlinkage of commodities with economic growth, say for any sort of economic growth, you have to have your cyclicals move first. And commodities plays through entire cyclical cycle. And which is the reason why, if we are talking about the mother of all bull runs about to happen, commodities has to be there. And which is what is going to be driving these in the coming months. So I think these are the big trends that one should be looking at. What I have not really talked about is asset classes, but I think apart from equities, which is the wealth focus idea here, one needs to look at fixed income idea very closely. Now, whether you look at interest rates being the reason for that, whether you see asset allocation as the reason for that, but passives is actually now playing out in a much bigger manner in India through a fixed income space. We already know that disinvestment triggered a passives rally for fixed income. But this year, we've seen actually more and more fund houses launch more fixed income products than even equity products, or larger AUMs in fixed income than in equity. So I'll maybe just pause here and we'll talk about it more in the following session.
Sure. So before moving to the next question, I mean, any questions? This is a request to all the participants. Any questions if you have, please feel free to post that in the Q&A session. The next question is, Abhishek, what are the different types of passive investment strategies available in India? And the most important thing is, how can investors choose for their respective portfolios?
Yeah, so that's an interesting one. Typically, when we talk about passives, Amit, we typically think of ETFs only. Now, passive, what does passive really mean? Passive essentially means that you are not active. Just like they say that, darkness is defined as the absence of light. Passives is defined as where human element is not there, or basically rules define, or objectivity is far more. There is no subjectivity of decision making. And as such, while ETS seems to be the face of passives, you have 2 other very important elements to passives business, which is index funds and fund of funds. Now, these 3 put together essentially form the body and soul of entire passives. But their focus is essentially to cater to different parts of the market. Now, people who basically just need an access to various markets could use essentially ETFs. For instance, if I want to go overweight in my portfolio on healthcare or technology, I could pick up a healthcare ETF or an IT ETF, right? But let's say if I want to go overweight on international equities, what do I do? Managing international, because of the time zone that we are in, how do you buy this? The best way to participate that is through a fund of fund. A fund of fund essentially is just giving control to another fund manager, or you are putting money in another ETF or an index fund which sits elsewhere in the world, which gives you exposure to another fund. So fund of fund is a brilliant route to build your portfolios. ETF is essentially for people who want to manage their portfolios actively, who want to be in control of their portfolios, and who are exceptionally conscious about cost. I mean, all of us are cost conscious, but people who want to be more active about it and who are conscious about the cost eating into the every trade, ETF, I think, plays a huge role. And then you have index funds. Index funds, I think, is one of the best things to happen after a long time. Over the last maybe about a year or so, we've seen about 68% CAGR growth in index funds AUMs. Roughly about 70% or to 80% of this has come through because of fixed income products. And largely these index funds are serving the purpose of giving A, access, and B, a very rules oriented, very objectively driven portfolio of a particular asset class of replicating a certain index. For investors who are either coming through an advisor or investors who are who want to be invested for a long term, not trade actively, the expense ratio that you see typically is all-in expense ratio. There is no trading cost, there is no custody cost, etc., that you have to pay separately. In an ETF, typically you end up paying, a trade cost as per your broking arrangement with your broker. In an index fund, you don't have to do anything like that. Your entire liquidity is managed by the fund house. While in an ETF, your liquidity is dependent upon how deep that particular index is. So a Nifty 50, Nifty senior essentially is deeper in terms of liquidity than a Nifty next 50, which will be deeper in terms of liquidity than a mid cap versus a small cap. So the deeper segments is typically where we launch the ETFs at this point in time. And wherever we want to have a rules-based approach, wherever we want to have that same sort of objectivity of passives, but this liquidity is a little scantier, we typically look at index funds as the route.
Thanks, Abhishek. Active versus passives, both go hand in hand. So many debates, so many views. But experts' view, please.
It's like yin and yang. One cannot live without the other, and there's a time and place for both. As we saw the first chart itself, there is always space for all sorts of strategies, and in different market phases, I think different strategies will play out. And as larger investors, as investors who are putting in larger sums, committing bigger amounts of money to the capital markets, you need to be conscious about a right mix in your entire portfolio. So what are more efficient pieces? What are more active spaces where you want to have an active fund versus a passive fund, or a passive fund versus an active fund, is something which has to be a serious call to be taken. But some of the advantages of both is what I would want to potentially tell you about. One is that with an active fund, there is always some sense of conservatism that comes through. Conservatism, rather than conservatism, I would rather say that you have a sense of prudence that comes through. So there is a potential alpha always on the table. That's what we are playing for. At the same time, whenever markets correct very sharply, remember passive funds or index ETFs, etc., they will always fall as much as the market. So if let's say Nifty is down 3%, the fund also has to be down 3%. The index fund or the ETF also has to be down 3%. But an active fund could potentially save you that 1% or 1.5% and give you that outperformance. In a more polarized sort of a market, in a market which is slightly more tougher, because of the design, active funds find it challenging, and as inefficiencies go away from the market. So for instance, large caps in India are no more inefficient. There are, it might be funny, but Infosys and Reliance have over 600 research reports written across the world. There are so many investors or analysts tracking these companies. Do you think that there is any sort of information arbitrage, or if you could generate any sort of an alpha? You could only generate the lack of it potentially by being underweight at times. And the design itself sometimes can force you to do that. So over a longer period of time, the deeper end, you will typically see passives outperforming actives. At the scantier end, so for instance, small cap or mid caps, you'll typically see active funds outperforming the index. So wherever there is room for creation of alpha, wherever there is some room for selection, active funds will always do better. In sharper downturns, typically active funds, because of the cash holding, because of conservatism, may outperform. But whenever markets are in a run up, whenever markets, the acceleration is required, typically it's the passive funds which will do that. So in your portfolio, you need to have both. If let's say quantitative strategies is up your sleeve, you feel that a more rules based approach which gives you access to all sides, you have active churn happening, but a limited amount of churn, passives or quantitative strategies could be your foray. One thing that I would want to point out as an advantage of both is that passive funds are very liquid. They're typically based on liquidity and transparency. They are simple products. What you see is what you get. While in an active fund, if you know the strategy and if you know the fund manager, I think that additional layer of risk management that comes across is what helps you. And when you start looking at different asset classes, you again also get a sense of, okay, in spaces where decision making is complex, maybe having an active fund is a good idea. In spaces where decision making is not so difficult, it's a homogeneous sort of a product like a gold or a silver or something like that, maybe you could just simply go for an ETF or an index fund. So that's how you go about it. But essentially, it's a trade-off between your room for alpha versus the cost you want to pay for it. And that's how you basically build a portfolio of both actives and passives. I would say that both actives and passives play a role, an active role in your portfolio. You should have a good mix of both in your portfolio. But from time to time, please do keep reviewing how much of active, how much of passive, and in what spaces you are.
That's a smart and excellent one, Abhishek. And of course, I mean, I think for any portfolio creation, active and passives, I think both are extremely important. And as I mentioned in the beginning, it's a Samvaad, and Samvaad is always both way. And already, questions have been starting pouring in. So let's quickly jump to the first question from Mr. Purohit. His questions are related to the tracking errors. So first question is, how much tracking error in passive funds for large cap, mid cap, and small cap categories? Is there? Second question is there any tracking error in active funds for large cap, mid cap, and small cap? And third one is where we can find tracking errors for both active and the passive mutual fund schemes.
Okay, so the third one is the simplest, and I'll take that first. You have these fund fact sheets typically, which will provide you this data of how much alpha, how much sharp trainer, and the tracking error, typically on various financial services portals like Value Research, Morningstar, or similar sort of analyst portals. You will find this data. This is very, very commonly tracked ratios. But let me tell you, Mr. Purohit, that for an active scheme, tracking error is a good thing to have. The more tracking error you have, it basically means that there is more active decision making being done. What we need to see is whether it's generating alpha or not. So don't be worried if you see a tracking error in an active scheme. In a passive mutual fund, now coming to the first two parts of the question, in a passive mutual fund, typically all the funds are approved by the regulator with a 2% tracking error cap. We try to keep it as low as possible, preferably zero, but zero is frankly not possible really. So typically you will see in large caps tracking error somewhere in the range of 0.001% or something like that. Maybe the second or the third decimal place. In spaces of mid caps and small caps, you would largely see tracking errors somewhere in the second or the first decimal place. In case of commodities like gold and silver, you could potentially have higher tracking errors because these are extremely volatile asset classes. Their daily volatility can be in excess of maybe even 2%. So having a tracking error of somewhere about 20-25%, 20-25 basis points is not a problem really. But lower the tracking error, better is that particular index fund or that ETF. That's the rule that you should always keep in mind while selecting your portfolio.
Okay. Thanks, Abhishek. Next, before moving to the next question, there is a raised hand from Mr. Madhava Variyar. Mr. Madhava Variyar, requesting you to type your questions in the Q&A session. Certainly, we'll take that. And this is to Mr. Prashant as well. So next question is from Mr. Satyanarayana. How the corporate action benefits on index ETF constitutes are passed on to the ETF holders?
I think it's a brilliant question. First of all, this is the first time I'm actually getting this question, and though it's slightly technical, but let me try and simplify this, Mr. Satyanarayan. In case it's not clear, please do let me know. We'll maybe handle it separately as well. Like a active mutual fund or like a normal portfolio, an index or an ETF portfolio also gets constructed. The difference is that there is no active decision making. I want to buy stock A 5% more than the index, stock B as 3% less than the index or something like that. Here, what I see in the index or the model portfolio for me is what I'm going to be buying in the portfolio, right? And all these companies have in the portfolio, and we are talking about equity here, all these companies, and one of the examples of a corporate action here is dividends, for example. Assuming that company A pays a dividend in January, company B pays a dividend in February, company C pays a dividend in March. As and when the dividend cash comes through, whenever the dividend announcement happens, the date of payment also is announced by the company. We typically watch out for that particular date, and the day that cash hits the portfolio, that morning itself, we immediately allocate that amount of money into all the stocks. So if let's say we are talking about Nifty 50, and if we've received, let's say 5 lakh rupees as dividend from one of the companies, we will distribute that 5 lakh rupee in the same proportion as Nifty 50 stands on that particular morning, not as per what was the rebalancing date, etc. So the cash essentially gets reallocated into your portfolio and into your NAV itself. Similarly, any other corporate actions, on the date of the corporate action coming through to the demat account of the fund, it gets distributed into the NAV and to all the unit holders, or in this case, it could be shareholders, right? So that's how it is passed on to all investors on a regular basis across all kinds of corporate actions.
Thanks, Abhishek. Next one is from Mr. Prasanna. Considering volatility globally on full-fledged or partial world war in next 2 to 3 years, what would be your advice to the people nearing retirement in couple of years to secure their corpus?
Sir, this is really a scary aspect. World war is something that is not a very healthy thing to have. But yeah, given the situation which is building up with Russia and Ukraine, one needs to be a bit cautious. However, I don't think it's got anything to do with people who are nearing retirement. Look at asset allocations very closely, very carefully. You should ideally not have more than maybe 20% of equity in your portfolio, especially for people who are in their 50s, late 50s. You should not have more than 20% of equity. If you have 5 years or more, then maybe you should look at aggressive equity. Otherwise, look at rather more hybrid spaces. And active funds perhaps, play a good role. They give you access to both equity as well as fixed income. However, if you have surpluses and if you really want to take bets, historically, wars have been a brilliant time to invest. It might sound paradoxical, but during wars or before wars, markets typically crash. And post-war periods is when you see maximum amount of acceleration in markets. It's a logical phenomenon. Typically, what happens is, and you could look back history and see, in the post-World War I era, you had huge amount of growth before the Great Depression came back in. First World War was from 1916 to 1919. The Second World War was, it was an elongated one, but it was a full-fledged one from 1933 onwards. 45 it ended, and in both cases, you can see that 5 to 7 years post the war was a huge amount of acceleration, both from markets and economy point of view. The reason is pretty simple. During wars, just like in any fight, you tend to lose a lot of fluids, a lot of nutrients from your body. Countries tend to lose a lot of resources, lot of population. In those days, it used to be population also, and a lot of part of their economy, a lot of growth. To catch that up, there used to be massive amount of investment going through, either through a monetary or a fiscal stimulus by the government. And that's why the following years used to be huge amount of economic growth, which used to come through in the stock markets also. So if somebody has cash, I think just before the wars, you should raise cash. During the wars, deploy that cash, and post the war, you should wait for your, bounty to come back in. But believe you me, one should try and stay away from speculating on wars or such events. These are very, very tricky, especially in modern times. You don't have very long periods of wars. If you look back the last maybe 10, 12, 15 years, wars typically last for not more than a couple of weeks, maybe a few days also. So it's very, very tricky. How do you time? From an asset allocation point of view, because you don't know which side the cat will turn, maybe go a little conservative, have maybe less than 50% of risky assets in your portfolio. Cut down on speculation during these periods is what I would say. But if you have, let's say, 5-7 years sort of horizon, don't be worried about these smaller events in life. I think markets will reward you massively for the conviction and for long-term holding.
Next question is from Mr. Patel. In case of fund manager fails to attract the investors, there will be a small AUM. Do you think this is going to affect the liquidity in case of passive ETFs? And what about the tracking error in this case?
Good question. So if you look at the number of ETFs which are out there right now, you'll see that 60% of the ETFs are not really great in size. But given the fact that, when we launch a particular fund, we always look at the underlying liquidity of scripts, underlying liquidity of indexes. The fund itself is fairly liquid. You do not really need to worry about the liquidity in the marketplace. The market making environment also is now starting to get better and better every passing day. So that's the other factor, other tailwind today that is available. And hence, I would recommend that don't be worried about small AUMs. If you like an idea, go for it. There is also a mechanism available if you're not getting, the right, if your ETF is trading at a discount for, 3 or 5 working days. If you're not getting a bid ask for 7 days, you can directly come to the AMC and claim that, give me liquidity, and we are obligated to provide that. For Birla, I can assure you that all our products are very, very liquid, and they are easily available for both buy and sell side ports. Whether a small AUM or a big AUM, no need to worry at all. Before we launch a product, we always stress test it. That's a policy that we have. And because of that same policy, even if it's a small AUM, let's say, something in the range of 10, 12, 30, 40, 50 crores, you do not need to worry. You can trade it easily. You can trade it in, or you can buy it out whenever you want to. There is very, very active market making support available. And if you feel the need, we are always there to help you directly as well.
Next one is from Mr. Mishra. For the short-term investments, which one will be a good one? I'm sure both from active and passive. Short-term, I'm sure, I think time horizon has not been mentioned, but still below 1 year, you can say as a short-term.
I think I'll go even further and I'll say that, I'm actually meeting a lot of people who are looking at LIC का IPO आएगा तो क्या करना चाहिए, क्या trade बनता है क्या? So that's a short term that we are looking at these days. And I would say, sir, that if you are an active investor, if you are keeping very strict tabs on your cash positions every day, if you can actively time the market, maybe trading a Nifty ETF is up your sleeve. You could potentially do that. But if you are looking at, let's say, a year plus sort of an investment, both an index fund or an active fund can serve the purpose. In let's say something a hybrid strategy, you are maybe better off in an active fund. If you are looking at something like let's say a large cap, you may be better off in an index fund or in an ETF. If you are looking at something in a mid cap or a small cap, you're definitely better off in an active fund because you need that selection support. But I think, as I said earlier also, you need to have a prudent mix depending upon the market phase. The current market phase that we are in right now, I think it's going to be a very, very interesting year going forward. Volatility is going to be higher. But at the same time, you are going to be, following a sine curve tending upwards. So if you have time at your hand and if you want to trade, have some part of your portfolio in funds and some part of your portfolio in ETFs that you can constantly trade in and trade out. ETFs offer you that brilliant support. You can even time it during the day. And the last few weeks, that's not a professional advice. You should ideally avoid that. But ETFs give you that flexibility. You want to trade at the 11 a.m. price, 2 p.m. price, 3 p.m. price. It's like a stock. You can trade it, buy today, sell tomorrow, buy in the morning, sell in the afternoon. You can do what you wish to.
Okay, thanks. Next one is from Mr. Prashant. For systematic withdrawal plan, what's the best strategy?
Systematic withdrawal plans, I think, is best done with fixed income oriented sort of portfolios. Ideally, do not try that, though equity funds also offer this strategy. I would strongly recommend that please do not try it on an equity fund because of the volatility. The day your withdrawal is getting hit, your AUM could be, your NAV could be trending down. So what will happen is that you will tend to lose more units than normal. So rather have it in a low volatility sort of a portfolio or have it in a fixed income oriented portfolio. In fixed income, we typically have these index funds where this facility is available. And I think, for instance, we launched an SDL PSU index fund in September. We launched a 100% SDL fund. Both these were 5-year oriented funds. You can actually do an SWP against those two products as well. It's not a bad idea if you are looking at building some sort of a cash flow stream, or even if you want to look at it in an STP into another equity portfolio. These are good ideas to work from.
Okay. Mr. Nayan is asking, what is the best passive investments as ETFs part of equity market, as this also dips a lot? What's your suggestion on this?
I would say that this is a difficult one. So I would say that, there is nothing called a best investment. There is the most appropriate investment in my opinion. Markets are going to be more volatile than what we've seen in the last maybe about a month for a variety of reasons. And by the way, volatility is the inherent feature of equity markets. There are these quantitative strategies which are starting to come in. It's called smart beta. Maybe you should have a look at this idea for sure. In fact, as a fund house, we are also very shortly looking at launching a bunch of smart beta ideas. These could be very, very interesting for you. Here, what we do typically, or what ETFs do is that they try to build portfolios around a certain strategy. So, for instance, one of the ideas is alpha low volatility. It will look at the companies which are least in terms of volatility across the board. So, if let's say you have Nifty 200, the 30 or 50 least volatile companies across the spectrum, and out of these companies, find out or screen out companies which are likely to deliver maximum amount of alpha. This is obviously based on certain quantitative techniques, but I think if you are wanting to avoid volatility, this is an idea for you. For investors who are looking at, I need peace of mind. I don't want, any sort of bad news on my companies, good quality companies. There is something called a quality as a factor. We're looking at launching that idea as well. So, of course, there is going to be volatility. Lower or higher could be a matter of time. But if you are that sort of an investor, maybe that factor is for you. And then there is a breed of investors who want, adrenaline rush. मेरे को सबसे तेज भागना है, मेरे को growth चाहिए, high growth चाहिए. Maybe momentum is up your sleeve. So that's another idea. And then there are these Warren Buffets and Charlie Mungers of the world who want long-term, deep value. I will buy cheap and sell when the market is appreciated or unlocked value. So that value factor is something that we try to build in that portfolio. All the companies that we buy, essentially the index will buy them when these companies are cheap and automatically churn them out when they become expensive. So your profit booking is getting intuitively done. You don't need to worry about it. So maybe that sort of an idea or that sort of an approach may help you going forward. And we could maybe, offline, we could try and help you with some of these suggestions as well.
Mr. Suresh is asking, what is the best fund for long-term goals such as retirement, Nifty 50, Nifty Next 50 or Nifty 100?
So if you're planning for retirement, depending on how far from retirement you are, you should look at the safety aspect of these indices. Nifty 100 is a accumulation of Nifty 50 and Nifty Next 50. But remember that Nifty Next 50 is a lot more balanced, sometimes a bit more aggressive than the Nifty 50. Nifty 50 is like, recently a friend gave me a very interesting analogy, is like, 11th, 12th wala student who is just appearing for entrances in graduation or engineering, etc. And Nifty 50 is like the guys who have already cleared school, matriculation, etc., and are already working on their graduation. They are already, senior guys, proven, tested. So if you are very near to your retirement, go for Nifty 50. If you have some distance, let's say you are somewhere in 40s or 30s, I think Nifty Next 50 is a better index for you. And if you're somewhere between, maybe look at Nifty 100 for you.
Next one is from Mr. Raj Purohit. Why alpha shrinks as more people invest in stock market?
Great. So alpha is a function of typically alpha, or alpha in other words is also inefficiency of the market. Room for alpha is the inefficiency of the market. Why does that alpha happen? What is alpha? Alpha is basically what the market generates and what I generate as an individual. Market does not give alpha. It's the individuals who are able to generate that extra bit of return. And that extra bit of return can only come if you know something that the market does not know. This is what is called information arbitrage. And as a lot of researchers and Markowitz, who wrote the theory of efficiency, market efficiency way back in 60s and 70s, as markets mature, as they deepen, there are huge amount of buyers and sellers sitting on that same script on both sides of the table. Basically, there are just so many people that information is not inefficient. Everybody knows every piece of information that comes through in the same way that it is intended to come through. So the only differences can be, have you bought it first or have you bought it last? Typically in that sort of a backdrop, sir, what happens is that not buying or not participating can only generate that alpha or the lack of it. Hence, by selecting that stock or by hitting that every stock in the portfolio, you are taking the index approach. And which is the reason why over a longer period of time versus individual investors, indexes in deeper markets where there is no information asymmetry tends to do better than active funds. In spaces like mid caps and small caps where there is less information going through or imperfect information going through, the room for alpha creation is much higher. That's where research plays a large role, because there is a large investment team, analyst team, which is sitting, watching every move of every management, reading, thousands and thousands of pages of filings, of data points, and then formulating, theories about where could this stock particularly go. They are not speculating. They are formulating informed judgments on, if a certain scenario happens, this is where the company could go. Or if another scenario or a worst case scenario happens, this is where the company could go. So that helps you take a much, much more informed view of a company. In, let's say, like a Nifty or a Nifty Next 50, where companies are top notch, where there is no differential research. If you see 5 different research reports, you'll probably see 95% of the research report is same. It's just the wordings which are different. The price points are not more than 10% apart, or 10%, I think was also a stretch, maybe not more than 5% apart. That's when you know that markets are deep. With mid caps and small caps, typically you see that the price points or the judgments can be wide apart. And that's where you see fund managers and analysts. And this is the reason why, sir, alpha gets shrunken over a period of time as markets mature, as markets become more developed. And information asymmetry is vanishing is the primary feature of developed markets.
Okay, next one is from Mr. Satyanarayana. Does ABSLMF has any ETFs to participate in Chinese equities, as also US indexes such as NASDAQ? If yes, how their performance has been over the last, say, 5 to 10 years?
Fantastic. So we don't have a China product at this point in time, though in our international equity fund, we have something called Aditya Birla Sun Life International Equity Fund. We have, I think, some bit of exposure to China. And there is another fund that we have, since you mentioned US as well. We have, you mentioned NASDAQ as well. We have something called ABSL NASDAQ FOF. So the NASDAQ FOF invests in iShares NASDAQ ETF, which is the most liquid or the largest NASDAQ focused ETF in the world. So we launched this fund only last year in September. And in that short period, it is by far one of the most liquid, by far one of the most well-tracking FOFs also in its peer set. I am sure that you are aware, but at the risk of reiteration, I would also point out that currently SEBI has stopped international exposures or incremental international exposures across the industry. Only for fund of funds which are investing in ETFs, currently this is open, and our NASDAQ FOF is one of the only, or I think maybe the only one, I'm not sure, is currently open for taking fresh subscriptions.
Mr. Patel is asking, how does the fund manager manage the listing and delisting of the constitute of index? How does it affect in case of both bearish and bullish market?
Great question. Whenever a corporate action with respect to listings or delistings come through, the exchanges send out notices in advance. We get, so there are a bunch of these reports that come through every evening to us, one of which is the index constituents of the day, trades of the day. Then we typically get all notices with respect to various companies that are there in the portfolio or in that index. And one of these reports is basically if there are any corporate actions coming up. Whenever such reports come in, our custodians keep a tracker in the portfolio and keep putting up flags for the action to be taken. Index providers like NSE, Asia indexes, MSCI, all index providers are also obligated to ensure that indexes do not suffer on account of these corporate actions. So whenever, first of all, whenever a new listing happens, typically indexes don't take into account these new listings unless these companies have a proven daily trading track record or a daily liquidity track record. So you'll see that it takes 6 months for any company to become a part of index after its listing or after its IPO, irrespective of the size of the listing. They are still not part of any index. Why? Because they need some bit of seasoning, some bit of daily liquidity proven track record to become a part. The second point was about demergers. When a demerger, etc., is about to happen, not demerger, delisting is about to happen. Typically, the delisting date is known in advance. Before that delisting happens, exchanges itself send out these notices to index providers and to us as market participants. The index itself churns out these companies. On the day of the index rebalancing, we also alongside churn out these companies from the portfolio, hence replicating the index company.
Okay. Next one is when we switch, say, from liquid fund to the index fund, which days NAV is considered for the index fund inflow?
As per the rules, sir, the switches have to be at the normal payment cycle of that particular fund from where the fund is moving out, and eventually as per the realization norms where the fund is going in. So when a switch request is given from a liquid fund on a T+1 basis, your switch in gets activated. So typically, let's say you've given a request on Monday for a switch from liquid fund into, let's say, our Nifty Next 50 index fund. We are actually listing our Next 50 index fund on Monday. Your exit NAV will be as per end of day for Monday, and your entry NAV book will be the NAV of Tuesday for the Nifty Next 50 index.
Okay. Next one is, can you please shed some more light and give examples on the expense ratios and brokerage equation for ETFs, index funds, and fund of funds? Example for ETF, it is expense plus brokerage. Fund of fund, it's expense plus expense of underlying, and index is the expense. Is it viable to answer this question? Yeah.
Just to simply put it, ETFs don't have multiple plans. They only have a single plan. Only at the time of listing can you invest at less than a certain amount of money, less than a unit creation size, what we call, which is typically an institutional size of investment. So there is generally no brokerage in ETFs. Only at the time of NFO can generally be there any sort of distribution expense. The FOFs and index funds are like other normal mutual funds. There is a direct plan and there is a regular plan. The difference between the two is what is available to be paid out as a brokerage or as a distribution compensation. In the direct plan, typically there is no any other marketing and selling expense. The only heads that you see typically are investor education expense, which is 2 basis points fixed for every scheme in the country. Even in ETFs, you have 2 basis points of expense ratio. for IE expenses, investor education. Then you have something called management expenses, or management fees, which is the earning that the fund managers get or the fund house gets. And rest of the expense is OPEX. That's typically to run the fund. It generally goes towards unit creation, custody, legal fee, registration fee, SEBI fees, etc., trustee fees, and so on and so forth. These are all administrative expenses. And in index, FOFs, and ETFs. ETFs is the lowest generally. They are very, very, very minuscule expenses. For instance, our Nifty ETF is a total of 5 basis points of expense. In comparison, the Nifty 50 index fund is slightly higher because it does have all these other costs, etc., associated. It may be somewhere in the range of 25 to 30 basis points. And then you have an FOF, which could be slightly higher because then there is an underlying fund also, which is the reason why these are laddered in terms of expenses. Depending upon the utility for your portfolio, the fitment in your portfolio, that's the choice that you need to make. Which one do you need to have? ETF, index, or an FOF?
Okay. Mr. Prashant is asking if I will invest long-term in aggressive fund for 15 years and do 8% systematic withdrawal plan for my total investment. Please suggest me good active and passive funds.
So a tricky one, sir. I think what you are seeking is that, how do I build up a portfolio from where I can have an 8% sort of a cash flow stream? Given that interest rates are not so high anymore as they used to be maybe 3-4 years ago, even after the rate increase cycle has been happening, I would first of all request you to revisit the 8% target. A safe withdrawal number will be somewhere closer to 6%. Given the fact that we went to, as low as maybe 4.5-5%, 6% means 50 basis points of your corpus getting redeemed every month. So you need to look at all schemes which are likely to generate 6% or higher on an annual basis, annual rolling basis in the portfolio. That's the first rule. If I were to work backwards, that's the way that you should be looking at. Depending on how far from retirement you are, your portfolio could be that much more aggressive. A very, very simple back of the envelope, thumb rule is 100 minus your age should be your equity allocation. So if let's say I'm 40 years of age today, 60% should be the equity allocation in my portfolio and balance should go into fixed income. Because I have 20 years to go, even on the fixed income side, I should be able to take some bit of duration. Index funds today are giving me a 5, 6, 7 years sort of an option. I would rather put money there. And maybe because there is 20 years, rather than go into an index fund, why? I'll go into my income fund, ABSL income fund itself, which is also running a roll down, which is taking action about, managing interest rate risk, etc. And the equity component, I might want to put it in our next 50 index fund. As I mentioned earlier, if you are far away from retirement, you should go into next 50. If you are near to your retirement, you should look at a Nifty 50. I think one of the questions were Nifty 50, Nifty next 50, and Nifty 100. So I would personally go for a Nifty next 50. And this mix, every 5 to 10 years, keep revisiting your asset allocation. Keep reducing equity, keep pushing more and more of fixed income. The day you retire, my guess is that you would have built up large enough corpus to do 8% or more also. I wish the best for you, but safely over the next maybe 10 years, you will see inflation and interest rates both moderating further in the country. You should look at not more than 6% of withdrawal on an annual basis, 0.5 every month. I think that corpus will generate enough for you.
Okay, we'll take the last two ones very quickly. Though we understand we are slightly ahead of the time. This one is from Ms. Saigal. What advice you will give on banking and financial services fund? And the next one is, and the last one is, how this combination, debt index fund, specifically SDL and PSU bond fund, maturing in 2026 and 27, uh, how they score over your normal bank FDs and other your active mutual fund schemes also.
Okay, so maybe we'll take the last one first. In terms of the SDL funds, given the fact that yields are pretty healthy, pretty hefty, not even healthy, they are unhealthily hefty right now on SDLs. You are getting zero credit risk. You are getting government of India risk, practically speaking. You should load up on yields as much as you can in your portfolio if your asset allocation permits. These are safe products, so to say. If you hold till maturity, you will get the interest yield, more likely to get the interest yield that you enter at. So they, compared to the FDs, are giving you very, very good value. Why? Because interest from FDs is taxable at your maximum marginal rate, irrespective of the fact whether it's come to your account or not. So if you take a 5-year FD, and you say that I've earned maybe 1 lakh rupees of interest this year, irrespective of the fact that this interest is actually payable to you at the time of maturity, a bullet payment, you will still have to pay tax, by the way, and you will be charged at maximum marginal rate. So let's say if your marginal rate is, let's say, 42% as an HI, you will end up paying 42,000 out of that 1 lakh rupee of interest, not having received 1 lakh in your account. In a mutual fund, the advantage is that you get capital gains benefit. Only on the date of your redemption does your taxation liability get created, and you don't have to pay it that day. You eventually pay it with your annual return, just that you become taxable for that particular year. So if you've bought just taking the example of SDL PSU 2026, in September 26, when the fund matures, following year when you're filing your returns, you will take the LTCG benefit. So if you have invested now for that product, you end up getting at least 5, if I'm not wrong, actually 6 indexation benefits, because you will be exiting in the year 26. So it will be financial year 27. In that year, you will have crossed over 5 indexation, 6 indexations. Practically speaking, 90% of your growth will go tax-free. Your post-tax return compared to an FD will be at least at an advantage of 2 to 3 percentage points. Mind you, you will be paying capital gains tax. I'm currently considering the prevalent tax laws. I don't know what will be prevalent in 26, 27, but as per the current tax laws, you will end up paying capital gains and not interest tax. So you are making money on 2 accounts. One is the treatment of the income. Second is on the actual yield itself. The actual yield for a 5-year index today is somewhere in the range of 6 to 620, while a 5-year FD is only offering you about 5 or 5.25 today. So on both these accounts, nature as well as quantum, you are better off in a fund.
What was your and the banking and financial services fund?
Yeah. So banking and financial, I'm assuming you're talking about the equity one here.
Right.
Over the last year or so, we've seen financials not do so well as they were expected to. Largely, that's on account of other sectors having done phenomenally well. Tech was the darling of the markets last year, and which is why sort of there is a value opportunity in financials. My sense is that as a value, banking and financial is a good pick to have for this particular year. During the last maybe 3 years, we've seen massive amount of cleanup in corporate balance sheets. We've seen, because of this inflationary cycle, we've seen many commodity companies, infrastructure companies making solid amount of profits, because of which many banks and NBFCs are likely to recover bulk of their NPAs or bulk of their loans, which were recognized as NPAs earlier. This is likely to put a lot of tailwind behind banking and financial sector. So if you want some selective sort of companies, if you want a fund manager to buy it for you, go for the ABSL Banking and Financial Services Fund. or if you don't want to, worry yourself about making a choice of companies or, a portfolio of businesses, etc., just simply go and buy a banking index or we have something called Aditya Birla Sun Life banking ETF. It's actually the lowest tracking error and the lowest institutional size. Only 3 lakh, 3.5 lakh is the minimum there. You could buy it on the exchange. You get the top banks. HDFC is something like 26, 27% there. ICICI is about 22, 23% there. SBI is about 19 or 20% there. These are some of the top banks in the country, leading banks. You don't have to worry. You don't have to apply your brains. Just simply buy it, sit it, forget it.
Okay, and this is last one is from Mr. Satyanarayana. He asked, please explain the expected performance of an index fund versus balance advantage fund over a period of 5 to 10 years from now. I know it's.
I'm not too sure whether it's justified or it's good to compare these two funds, because one is an apple, the other is an orange.
Right.
Index fund is typically 100% fully invested equity portfolio, while the balance advantage fund is positioned more as a low volatility equity solution, which is trying to manage your equity exposure depending on the market environment. Now, if the markets are expensive, valuations are high, typically the fund manager will bring down the the equity exposure in the portfolio, and vice versa. So given this sort of an approach, historically we've seen and we've simulated this sort of a strategy as well offline. Index fund is likely to deliver you what the CAGR return of markets over the next 10 years. I'm personally a very bullish person. So I would say that over a 10-year period, markets should generate somewhere in the range of 12 to 14% sort of returns on a CAGR basis. Historically, they've done 17, 18%, but I don't think 17, 18% is likely to happen again. That used to be also the time when inflation used to be 13, 14%. Now our inflation has come down to 4 to 6% range. So I think 12% is very aggressive. But mind you, in an index fund compared to a balance advantage, you will witness higher volatility. You will see more drawdowns. You will see on a daily basis, the NAV number or your portfolio value number fluctuating far more than a balance advantage.
Sure. So thanks, Abhishek. I mean, there are so many thank you notes which are once again pouring. Just one I will read for you. Mr. Praful Kumar Patel says, thanking you, Abhishek. It has been enjoyable and absorbing. See you later in the future. I'm an NR investor residing in New Zealand. Bye. So there are, so many good wishes. So thank you for all these wonderful insights. And, if I just want to 3-4 quick points from our conversation that, active and passive both go hand in hand. For the portfolio creation, I think active and passive, I think both are equally important. Specifically during, considering the low rate regime, I think this debt passive fund, specifically, 5 years, 6 years maturing in 26 or 27, I think that really makes sense because, they earn good returns. I don't say, but they score or normal or your, bank FDs. Banking and financial services fund, once again, which is, I think very good. I should not say entry point, but I think we feel, considering all the valuations, that's advisable from our research desk. So thank you, Abhishek, for all the insights, and thank you all the viewers and participants, for joining over this call. So as I say, this is a value addition platform, and every third Saturday of the month from 11 to 12 p.m. We will meet you on this platform. So see you in the next month, third Saturday, 11 o'clock. So stay safe and take care. Thank you so much.
Thank you so much. Wish you all the best in life and look forward to seeing you again.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।